The fundamental challenge in speculation is not predicting the market, but conquering the internal emotional extremes of greed and fear. These two powerful forces, when left unchecked, guarantee the destruction of capital and the systematic failure of even the most robust trading strategies. Jesse Livermore, the legendary speculator, understood that the market itself is merely a canvas upon which human psychology plays out its predictable, ruinous drama. His lasting legacy rests not just on his enormous gains, but on the systematic psychological discipline he enforced upon himself, which separates the successful speculator from the impulsive gambler. We will now examine the 10 golden lessons derived from Livermore's operational methods, focusing exclusively on the mastery of self rather than the mastery of external market mechanics. These principles serve as an enduring psychological blueprint for navigating the emotional battlefield that is the financial market. Lesson 1. The Golden Rule of Loss Management, Controlling Fear. Cutting losses immediately is the single most paramount rule in speculative trading, serving as the bedrock of capital preservation. The primary objective of any trade, once entered, shifts from being right about the direction to ensuring that the potential error is minimized and contained. Livermore recognized that the market will inevitably prove a trader wrong sometimes, and the professional's response must be immediate, decisive action. This imperative requires the establishment of a mental stop-loss before the trade is even initiated, a point at which the position will be liquidated without hesitation. The practical necessity of selling a position that moves against the trader by a defined small percentage exists regardless of future hopes or external commentary. Hope is an expensive emotion in the market, often leading traders to rationalize poor performance instead of accepting the initial mistake. This calculated discipline ensures that small, manageable losses are taken consistently, preventing any single trade from crippling the overall trading account. Livermore's profound insight was that the fear of taking a small, immediate loss leads inevitably to the certainty of taking a catastrophic, account-destroying loss later on. The psychological hurdle is accepting that a loss is tuition paid to the market, not a personal failure that must be immediately corrected by doubling down. Traders must understand that capital preservation is the foundation of longevity, and no strategy is successful if it exposes the entire bankroll to ruin. By cutting losses swiftly, the trader retains the mental and financial capacity to re-enter the market when a genuinely favorable opportunity presents itself. This initial lesson is the hardest to master because it requires the speculator to admit error, a psychological task that ego fiercely resists. Before we continue dissecting the psychological rules that govern the success of Jesse Livermore, please take a moment to subscribe to this channel and leave a quick comment below. Even just a single word or a simple emoji greatly assists the algorithm in recommending this essential psychological content to other traders seeking discipline. This simple action shows me that this kind of practical analysis truly matters and is worth the extensive effort required to produce it consistently. Furthermore, I urge you not to forget this resource during those challenging times when trading becomes difficult and your confidence starts to waver. Returning to these core principles provides the necessary anchor to stabilize your emotional responses when the market feels overwhelming. Lesson 2. The Folly of Averaging Down, Controlling Greed and Hope. Averaging down is perhaps the most common and destructive emotional mistake made by novice and undisciplined traders, violating the core principle of capital efficiency. This practice involves reinforcing a losing trade by purchasing more shares at a lower price, desperately hoping to lower the average cost basis. Livermore insisted that if a trade is moving against the entry point, the initial premise for that trade was fundamentally flawed or premature. Doubling down on a mistake is never a strategic decision. It is merely the emotional response of hoping the market will eventually validate the trader's initial incorrect judgment. The specific method of averaging down is pure speculation driven by an unwillingness to admit defeat, disguised as a calculated investment maneuver. When a position is losing money, the market is sending a clear signal that the direction of least resistance is currently opposite to the trade. Adding to this losing position means committing more good money to rescue bad money, exponentially increasing the risk profile of an already troubled trade. This behavior is fueled by a toxic combination of ego and greed. The ego refuses to be wrong, and the greed wants the position to return to profitability immediately. The key insight that separates the professional speculator from the amateur gambler is the acceptance that the market is never wrong in the short or long term. Individuals are the ones who make errors in timing, analysis, or execution, and the market simply reflects these misjudgments through price movement. Continuing to average down is a direct psychological battle against the objective reality presented by price action, a battle that the trader will invariably lose. Successful trading demands humility and the recognition that accepting a small loss is far cheaper than funding an emotional rescue mission. Lesson 3. Patience and the waiting game, controlling impatience and fear of missing out. True wealth in speculation is not generated by constant activity, but by the profound discipline of patience, waiting for the optimal market conditions to align. Livermore noted that big money is made only when a speculator can sit tight, avoiding the temptation to trade continuously and wait for the line of least resistance to become undeniable. This line of least resistance is the clear, established trend that market forces have already confirmed. Trading during periods of uncertainty, when the market is choppy or directionless, is merely speculating on noise and increases the probability of poor execution. The necessity of doing nothing during periods of market uncertainty is a difficult psychological concept for many active traders to embrace. There is an inherent human desire for action and immediate gratification, which the market exploits through the fear of missing out, FOMO. Livermore's method was to only trade when the signals were crystal clear, and the market movement strongly confirmed the analysis, often after a significant pivot point had been breached. This disciplined waiting ensures that capital is deployed only when the probabilities are heavily weighted in the trader's favor, rather than being scattered across dozens of marginal opportunities. The greatest temptation a speculator faces is the psychological compulsion to always be trading, believing that every fluctuation must contain an opportunity. This hyperactive approach leads to emotional fatigue and the erosion of capital through unnecessary commissions and inevitable small losses. The professional understands that the market must confirm the trade, not the other way around, and that sometimes the most profitable action is the absence of action. Patience transforms the trader from a reactive participant into a selective sniper, waiting for the perfect moment to strike. Lesson 4. Letting profits run, controlling premature fear. The second major manifestation of fear in trading occurs when a position moves into profit, leading the speculator to take small gains prematurely. This premature liquidation is driven by the primal fear of losing paper gains, the psychological anxiety that the market will reverse and steal the profit that has already been earned. Livermore stressed that substantial, life-changing money is never made by taking quick, small profits. It is made by having the courage to hold a winning position through normal fluctuations. This emotional weakness prevents traders from capitalizing on the full extent of a major market move. The specific method for countering this premature fear involves objectively identifying the difference between minor fluctuations and genuine significant trend reversals. Traders must define their exit criteria based on structural market breakdowns, such as the violation of key support or resistance levels, or the use of mechanical trailing stops. Exiting a trade should be a rational decision based on the market breaking its established trend, not an emotional reaction to a temporary dip in price. The successful speculator understands that volatility is inherent in profitable moves and must be endured. The psychological courage required to be patient with a winning position is often greater than the courage required to enter a trade initially. When a trade is working, the speculator must fight the internal urge to secure the profit immediately, trusting the trend until objective evidence proves the trend is broken. Livermore taught that the market will eventually give the signal to exit, and forcing the issue prematurely due to anxiety leaves substantial money on the table. Allowing profits to run is the reward for the patience exercised during the waiting game and the discipline applied to loss management. Lesson 5. The danger of overtrading, controlling hyperactive greed. Overtrading is the direct result of hyperactive greed, a psychological need for constant market engagement that ultimately destroys long-term profitability. Constant action is driven by an underlying emotional need for excitement, immediate validation, or the belief that the market is a perpetual motion machine of opportunity. This relentless activity systematically drains capital through excessive commission costs, poor execution resulting from hurried decisions, and the simple fact of trading against the major trend during periods of consolidation. The market rewards calculation, not hyperactivity. Livermore's specific method involved trading only in the major swings, recognizing that the market offers only a few truly highly profitable directional opportunities each year. He viewed the intervening periods as noise, designed to trap and confuse the undisciplined trader. The speculator must cultivate the ability to differentiate between minor daily volatility and the significant sustained movements that produce substantial returns. Attempting to scalp or capture every minor fluctuation is a fool's errand that guarantees psychological and financial exhaustion. The key insight here is that successful speculation requires substantial time to observe the market, to analyze the developing patterns, and to wait for confirmation, rather than requiring continuous movement. Overtrading is the antithesis of this calculated approach. It is gambling disguised as business. By limiting trades to only the clearest, most compelling setups, the trader conserves capital, reduces emotional stress, and focuses their analytical energy where it matters most. Discipline means recognizing that the market is a marathon, not a sprint, and conserving energy is paramount. Lesson 6. The delusion of tips and inside information, controlling external greed. The reliance on external tips, rumors, or supposed inside information is a profound surrender of personal judgment and a manifestation of externalized greed. Livermore vehemently argued that trading decisions must be based solely on objective market observation, price action, and the speculator's own rigorously tested system. Seeking tips is driven by the greedy desire for an easy, risk-free shortcut to wealth, bypassing the necessary intellectual rigor of independent analysis. This approach guarantees reliance on unreliable sources whose motives are often suspect. The specific method Livermore employed to counter this reliance was the development and unwavering trust in his own system of recording and analyzing market action, famously referred to as his tape-reading method. This method involved systematically tracking price movements, volumes, and market structure to form independent conclusions about the line of least resistance. He understood that relying on external chatter means placing the fate of one's capital in the hands of strangers who do not share the speculator's discipline or risk tolerance. Information that is widely distributed is, by definition, already priced into the market. The key insight is that the only truly reliable source of information available to the speculator is the market itself, expressed through its objective price action. Gossip and tips are instruments of emotional manipulation designed to instill fear or greed in the recipient. Professional traders ignore the noise and focus on the signal, the confirmed movement of price. Trusting one's own analytical system, even when it leads to losses, is infinitely more sustainable and profitable than chasing the phantom promise of easy money offered by anonymous sources. Lesson 7. Understanding the limits of margin. Controlling reckless greed. The misuse of leverage, or margin, is the fastest, most effective path to speculative ruin, directly fueled by the greedy desire for exponential returns in the shortest possible time. Leverage amplifies both gains and losses, and the reckless pursuit of maximum exposure demonstrates a fundamental misunderstanding of risk management and the necessity of survival. Livermore repeatedly warned against the temptation to utilize every dollar of available margin, recognizing that this practice removes all safety buffers. The market is inherently unpredictable in the short term, and unexpected volatility can wipe out a maximally leveraged account instantly. The specific method for managing margin involves always reserving a significant portion of capital as an untouchable safety cushion, ensuring survival through inevitable periods of adverse market movement. This reserved capital acts as insurance against the unexpected, allowing the speculator to ride out temporary drawdowns without facing a margin call or forced liquidation. By maintaining liquidity, the trader ensures they are always solvent and ready to capitalize when the major, confirming market moves finally occur. Margin should be used judiciously to enhance returns, never to maximize immediate risk. The key insight guiding the responsible use of leverage is that the primary goal in speculation is simply to stay in the game long enough to capitalize on the major moves. Reckless greed, manifested through over-leveraging, prioritizes immediate spectacular gains over long-term survival. A disciplined speculator understands that a moderate return achieved over 5 years is infinitely superior to a spectacular blow-up achieved in 5 months. Survival is the ultimate metric of psychological discipline in a high-leverage environment. Lesson 8. Recognizing the psychology of the crowd, controlling individual fear and greed. Successful speculation requires the ability to observe public sentiment and identify the dangerous extremes of market psychology, peak euphoria driven by greed and peak despair driven by fear. Livermore recognized that major market turning points are always characterized by these emotional extremes in the general trading public. The professional must detach from these mass emotions and use them as a contrarian indicator. When everyone feels the same way, the market is usually at an inflection point. The specific method is the necessity of selling into great strength when the public is most enthusiastic, euphoric, and convinced the market can only go higher. Conversely, the speculator must buy when the public has capitulated, when fear has reached a paralyzing extreme, and the news flow is overwhelmingly negative. This contrarian approach requires significant psychological resilience, as it means acting against the overwhelming consensus and enduring the discomfort of being initially wrong. The herd is almost always right in the middle of a trend, but always wrong at the pivotal turning points. The key insight derived from observing crowd psychology is that substantial profits are often made by standing firmly against the prevailing emotional tide of the majority. When greed dominates, prices are unsustainable. When fear dominates, assets are undervalued. The disciplined speculator must cultivate the ability to think independently and resist the powerful psychological pull of conformity. This detachment prevents the individual from succumbing to the collective mania of greed at the top or the collective panic of fear at the bottom. Lesson 9. The importance of the pivot point, controlling entry fear. The pivot point is a critical concept designed to remove emotional bias, specifically fear and premature greed, from the entry decision. Livermore taught that a speculator must never enter a position until the price clearly and decisively clears a critical resistance or support level that confirms the market's intention. Hesitation, fear, or rushing, greed, before this confirmation point leads to poor entries, resulting in trades that immediately move against the speculator and erode confidence. The pivot point is the mechanical trigger that validates the analytical thesis. The specific method involves using clearly defined pivot points based on historical price action to confirm both direction and momentum before commitment. If the price fails to break the pivot point, it signals uncertainty, and the disciplined response is to wait, regardless of how compelling the trade setup appears. By waiting for the confirmation, the speculator avoids the costly emotional trap of trying to anticipate the move before it is ready. This approach minimizes the time spent holding a position that is moving sideways or moving against the initial bias. The key insight is that the trade must objectively prove itself right before the commitment of capital is made, transforming the entry from an act of hope into an act of confirmation. The pivot point provides a mechanical trigger that eliminates the emotional debate of, should I enter now, and replaces it with the objective reality of, the market has confirmed the direction. This discipline ensures that the speculator is always trading with the established momentum, significantly improving the probability of success from the outset. Lesson 10. Separating personal ego from performance, controlling self-inflicted greed fear. The final and perhaps most encompassing lesson is the necessity of separating personal ego from trading performance, recognizing that the market operates without regard for the individual. Personalizing gains or losses is the root cause of emotional overreaction. Successful trades lead to overconfidence and reckless greed, while losing trades lead to shame, fear, and revenge trading. Livermore understood that the market owes the trader absolutely nothing. It is an indifferent force. The specific method for achieving this detachment involves maintaining detailed, objective records and viewing trading strictly as a business of probabilities and risk management. Losses must be treated as tuition, the cost of learning how the market is behaving currently, rather than personal failures that must be immediately rectified. By focusing on the process and the system, the speculator shifts the focus from the outcome of a single trade to the long-term probabilities of the overall methodology. This business mindset neutralizes the destructive cycle of emotional trading. The key insight that governs all speculative success is that the greatest enemy a speculator faces is always within himself, residing in the unchecked forces of greed and fear. Mastery of the market is unattainable until the trader achieves complete mastery over these internal psychological forces. By adhering to mechanical rules, accepting losses dispassionately, and treating the market as a laboratory of probabilities, the speculator overcomes the self-inflicted wounds that plague the majority of traders. The separation of self from performance is the ultimate act of professional discipline. Jesse Livermore's extraordinary success was fundamentally rooted not in any superior predictive ability or secret formula, but in the relentless application of superior psychological control and disciplined execution. He recognized that market mechanics are static, but human emotions are volatile, and the volatile emotions of the masses create the opportunity for the disciplined few. His rules were designed to neutralize the inherent human tendencies toward impatience, hope, ego, greed, and fear, transforming speculation into a repeatable, methodical business endeavor. The market reliably provides the opportunities driven by the cyclical nature of human psychology and the resulting price movements. However, the speculator's success depends entirely and exclusively on their ability to manage the internal forces of greed and fear that constantly threaten to derail their strategy. Mastery of the market, therefore, is not about technical analysis or economic forecasting. It is, first and foremost, the complete, unwavering mastery of the self. This internal discipline is the true golden lesson of the legendary speculator. For those dedicated to moving beyond emotional trading and achieving the level of psychological discipline discussed today, there is no better resource than the classic text that documented Livermore's life. We highly recommend the new definitive edition of Reminiscences of a Stock Operator, the timeless masterpiece by Edwin Lefebvre. This edition offers a profound analysis of Livermore's psychological strategies, augmented with unique commentary and chapter breakdowns that translate his century-old experience into practical, actionable lessons for the modern trader. It is not just a story, it is a masterclass in market psychology, offering the detailed context necessary to internalize these 10 lessons and implement them effectively in your own trading. You can find the link to this essential read directly in the description below.